Good afternoon, good afternoon, good afternoon, everyone. I want each and every one of you to subscribe to my YouTube channel. I'm about to do a fascinating interview with international business expert that specializes in private equity. His name is Adam Coffey. So stay tuned.
Hey,
Hey, Adam, how you doing?
I'm doing good. How are you?
I'm doing great. It's getting better each and every single day.
Yeah, well, hey, I'm blessed. I'm vertical. So every day I'm walking around is a good day.
That's absolutely amazing. Where you calling in from?
I am in my home office just outside of Dallas, Texas, near the DFW airport, which makes me highly mobile. I can be at my gate in about 20 minutes and can fly direct to anywhere in North America in under 3 hours.
Okay. Yeah, it's beautiful out there in Texas.
It gets hot at times, but it has. I think what I love the most about Texas is the 0% state income tax.
I
Where's
love
home?
that as well.
Where are you at?
Philadelphia.
Yeah, Philly, good town.
Absolutely, absolutely. I appreciate you coming on my platform today and conveying value to my audience.
Absolutely, happy to help.
All righty, you ready to rock and roll?
Let's do this.
All righty. Can you hear me good?
I can.
All right. Good afternoon, everyone. This is Arthur Robinson Jr. I'm the creator and host of the Powerful Interviews podcast. And today I have another special interview for each and every one of you. Today I have a wonderful person on the show, and he's a great friend of mine. His name is Adam Coffey. For those that don't know Adam, let me explain to each and every one of you about this incredible, phenomenal man. Adam Coffey is a successful businessman. He specializes in the private equity sector. He is an author, an engineer, and he is the best-selling author of his phenomenal book, which is called The Private Equity Playbook. And that is an awesome, impressive resume. Without further ado, I'd like to welcome the one, the only, the powerful Adam Coffey to the show.
Arthur, how are you, my man? It is good to be here. Good to be here and talking to your audience. I'm privileged. Thank you for having me on. Ready to talk shop.
Well, I'd like to thank you, Adam, for taking time out of your busy schedule to educate me and the audience worldwide about your phenomenal book, The Private Equity Playbook. I gladly appreciate it.
Glad to be here. Let's dig in.
What I'd like to know, and can you explain to the audience in layman's terms, who is the phenomenal Adam Coffey? How long you been in your powerful industry, and what is your expertise?
So when I meet people for the first time, Arthur, I tell them there's 4 things about me that put me where I'm at today. First thing is service in the military. I was a soldier in the U.S. Army. The military taught me something about discipline, teamwork, and leadership when I was a young man. Definitely a good foundation to build my future career on. Secondly is engineering. So as an engineer, I'm a meticulous planner. And I blame engineering for making me kind of that anal retentive strategic planner. I'm never shooting from the hip. There's always a plan in place. Things happen in the world that cause you to alter direction, but I adjust, I adapt, but at the same time, there's always a plan in place guiding my efforts. Thirdly, then General Electric. So at GE, I was at GE back in the Jack Welch era. I call it the Camelot era of GE. During the last 10 years of Jack's career, my 10 years at GE, what you had is pre-tech. So the technology companies don't exist yet. And GE is the world's largest company. It's #1 on the Fortune 500 list. It is the original Dow component on the stock market. And it's the world's most admired company. And about every 3 years, the stock is doubling. This is an old 100-plus-year-old industrial company that is reinventing itself every 3 years, and the stock is doubling every 3 years. Magical time to learn how to run a business. And so I credit GE the Jack Welch era GE with teaching me as first as an engineer, then I crossed over into management as an up and coming executive, how to run a business. And then fourth and finally, it's just experience. So I spent 21 years as a CEO building 3 different national companies for 9 different private equity sponsors. During that time period, I bought 58 companies, put them together. I have billions in exits. I'm known for building really strong employee-centered cultures. You mentioned I've got 2 #1 best-selling books. I spent 15 years teaching at top university business schools and hung up my CEO cleats. I figured I'd walk out kind of on top after 21 years. Really, I was kind of bored, 21 years being a CEO. And I was loving teaching. I made money being a CEO. I didn't make any money teaching. And I figured I would change my paradigm around. I wanted to impact multiple companies at a time. And I wanted to have a positive impact on people who were building businesses and trying to find their way and navigate through this thing called private equity, which very quietly over the 21 years I've been there has grown from hundreds of billions of dollars in assets under management to more than 5 trillion. As a matter of fact, today, private equity, if it was a country, would have the 3rd largest GDP on the planet. And so currently today, private equity buys, and sells 50% of all businesses on the planet are bought and sold by private equity. So it's very quietly become the world's largest economic force, private economic force. And the average layperson, business person just really doesn't have a good understanding of it. And so part of my mission now in life, I consult with private equity firms. I help them with their investments. I sit on boards of private equity backed companies. I work with leadership teams. I'm working with more than 50 founders today to help them grow their businesses. So I accomplished my goal, replace my CEO income without being a CEO, invest in other people and spend time doing the things I love. And it kind of has reinvigorated my career. So that's what I'm all about today.
Most private equity firms invest cash into a company in exchange for equity shares. How do you feel about that business method?
So I think from a model perspective, there are more than 6,000 private equity firms on the planet. So like any industry that has that size and that much activity, there will certainly be good firms, bad firms, mediocre firms, small firms, large firms, and this industry is no different. So there are a lot of different size, shape, and look and feel private equity firms that are out there. In general, if you think about when people invest money, when they invest in the stock market over about a 30-year period, they'll average about an 8% return per year. In the private equity world, when people invest in private equity, typically that return is more than double the S&P 500 or more than double the total stock market. So I call the world of private equity the world's most sophisticated asset and investment class that there is. And if you're an entrepreneur, you can't look at selling your business to a private equity firm as being kind of a one and done event. Selling your company doesn't have to be a destination. I call it the first rest stop on the wealth creation highway. So I as an entrepreneur, I build a business, I get to a certain size, I want to monetize this asset that I've built. I want to put some money aside, diversify my assets and protect my family. But I'm not ready to give up. I got game left. And so I want to continue. And so what I can do when I sell to a private equity firm, I can kind of ride the coattails of a sophisticated set of investors who are going to supply me with the capital and the financial engineering and structure that I need to continue building my business using what I like to call OPM, other people's money. Instead of risking my own, I took some chips off the table. I roll some money forward. I'm now working side by side with a very sophisticated investment class who is known as a private equity firm. And I become a portfolio company, and I now work to grow my company to new heights. And I'm no longer the main shareholder. I'm now a minority shareholder. And that's okay. It's okay to not be the majority shareholder. they can really help raise the sophistication of any business. They can help us attack growth and mergers and acquisitions and really do things that we couldn't do alone as entrepreneurs necessarily, but with access to capital and access to the debt markets that they bring, we can really ramp up our growth trajectory. And most importantly, as an entrepreneur, I can get a second bite of the apple or a third bite of the apple. My current record is selling the same company 5 times in 13 years and getting 5 different paydays. So it's not that I'm selling and walking away. It's I'm selling and continuing my journey, and I'm partnering with someone. And like in all industries, the devil's in the details, and it's how do I pick the right partner? That's kind of the key to success for an entrepreneur.
Now, when entrepreneurs and business owners actually take their business public, that's actually the data is with the SEC, which is Securities and Exchange Commission. Would that be accurate?
When you go public, a part of that process, it takes about a year to go public. But public is really for much larger companies. And I think oftentimes when people do go public, they tend to go public too early. And if the company isn't big enough to go public, the stock winds up being very thinly traded, and the outcome for the business owner is not as attractive as potentially staying private and focusing more time and energy on growing a larger private company. So I generally like to see companies stay private until they get bigger. But the process of becoming a public company takes about a year. It's very expensive. And there's a lot of transparency requirements, a lot of regulatory requirements. And yes, it is overseen, call it, by the Securities and Exchange Commission. And so it's a different world. And if I'm a public company, I have a lot of responsibilities to be making regular reports to the general broader public. Private company doesn't have to do that. Private equity funds. So if you're referring to how funds and firms are rated, I like to tell people who don't know anything about private equity to think about private equity as a mutual fund. Most people get the concept of mutual fund. A mutual fund aggregates money from a lot of different investors, pools that capital together, and then it makes investments in stocks, or depending on what the purpose of the mutual fund is, it will invest a certain way as outlined in its prospectus. Mutual funds are publicly traded. They have instant liquidity. If I want to know how a mutual fund is doing, I can look at ranking systems and criteria like Morningstar. This one's a 5-star fund. That's a 4-star fund. A lot of information, and I have liquidity. Private equity works pretty much the same way, only it's wealthier investors. Generally, the smallest investor size in private equity is 5 million. And so people who are investing their capital are giving it to a private equity firm. This is a private fund. There is no liquidity. The funds last for 10 years. And so I'm kissing money goodbye for a very long time, up to 10 years. And they're going to invest that money. Generally, they'll buy private companies during the first part of the 10-year fund life. They'll be improving them in the middle of the fund life, and then they'll be selling them on the back end. And if I'm an investor, an accredited investor who's got enough capital to be investing in private equity funds, there are ranking systems just like Morningstar for private equity funds as well. But by nature of the fact that private equity is private, I can't always just go on the internet and do a Google search and find out about private equity fund rankings. I have to subscribe to a service where this information is available. And then I can look at, there's all these different funds, where would I want to invest as an investor based on the type of investments they make, their historical returns, things like that. When I'm an entrepreneur selling a business, I have to do my own diligence, just like the private equity firm is going to look at my company very carefully before they make an offer and buy it. I need to decide, is this a firm I want to partner with? Is this a firm that I want to keep working with after the transaction, after the sale? Assuming I'm going to stay and keep building the business, then I have to do my diligence and check out that private equity firm as well. I'll be asking for historical information about the different funds they've raised, the financial performance of those funds, I'm going to want to talk to CEOs and entrepreneurs like me who sold businesses to them. I want to find out what it's like to partner with these people. Am I going to regret this decision after I sell my company? And so sellers also need to do their diligence when they're checking out the world of private equity to make sure that just because the phone rang doesn't mean I'm answering and I'm talking to the right firm. There's 6,000 firms out there, and I need to make sure that they meet my personal goals and objectives as a person that I want to invest in and work with over, the next 5 or 6 years during the future of my company.
Mhm. So if you want to take your company public, the first thing you have to ask yourself is, why would your company be valuable to the current public marketplace? Can you explain to the audience or give them a case study where entrepreneurs or business owners were actually looking for your advice to help them to take their company public, or to help them to scale their company from 5 million to, let's say, 50 million?
Yeah. So this is how I earn a living, is helping entrepreneurs. So I've built multiple businesses with hundreds of millions of dollars in revenue that sold for billions of dollars at exit. I never took any of my companies public. So I think of private equity as a pyramid, and as companies get larger, they're moving up the pyramid, and the pyramid's getting narrow as it gets to the top. And there's a lot of small private equity funds that buy small companies. They help them get a little bit bigger. And then another set of private equity investors come in and they help it get bigger. And all of these different groups are helping companies climb the private equity pyramid. Once we get to the top of that pyramid, generally the company has over $100 million at the EBITDA line, call it earnings before we pay taxes, we pay debt on loans, we pay for trucks or plants or things that we invest in. I call it earnings before we buy stuff. That's what the EBITDA line is. And once a company gets to a certain size, it's really hard to stay in the private markets. It's harder. You can't, these PE funds, they exist and they have to return the capital to their investors within a 10-year horizon. And they have nobody to sell the company to once they get to a certain size. And then going public is the next logical step to do. So I'm involved primarily on the private side of building companies, helping entrepreneurs go from, really, if I think about the pyramid, they're going from 0 to 15 million in earnings, 15 million to 50, 50 to 100, 100 to 200, 200 to public. That's the kind of the different channels that private equity is playing in. And so I'm helping entrepreneurs, and as they get bigger, they have more formal boards of directors, even though they're private companies. And I may be the executive chairman of the board. I may be working with a leadership team and working with a CEO every week and helping them with strategy, helping them with navigating growth and mergers and acquisitions and strategic planning, for their future. They're responsible for tactical execution. I'm a tool that they're using to help understand growth. And I think entrepreneurs, just like people in life in general, when you've been running a small company, as you're getting bigger, you're learning new skills. And it's good to surround yourself with people who've kind of been on that journey before you, and they can mentor and help you be successful. So in every case, when I've built companies myself as a CEO, there's been some kind of a strategic plan in place that we were following. There was a lot of activity. We were hiring people. We were growing. We were managing our initiatives in order to grow scale and size. When I'm working with private companies, I'm doing the same activity I did as a CEO. I'm just no longer responsible for the day-to-day tactical execution. But again, public should be reserved for large companies. And I think companies that have under 500 million in revenue, huge mistake to potentially think about going public. You go to public when you can no longer work within the capital constraints of the private markets. So as I'm building my companies, I'm borrowing more money. What goes public first really is kind of my debt. Banks that, I need a lot of money and a lot of capital when I'm building a big company, and the banks that are going to make the investments in my debt are publicly traded. And so my debt has to be rated by the rating agencies. Normally in a private company, the first semi-public activity is getting rating agencies like Standard & Poor's, Moody's to rate your debt so that public banks can trade in and out of your commercial debt or your paper. And it's kind of taking your company half public, if you will, at that time. And then as you continue to grow, eventually it's just, there is no further market in the private market. The only place we can get liquidity as a privately held company that's of a certain size is by going and selling it into the public market. So IPO should really be reserved for large companies over 500 million in revenue that have significant growth trajectory ahead of them. And because there's a cost of going public, there's a compliance requirement. It adds millions of dollars in cost to a company, and very stringent how you operate a public company and operate in a public company environment. And that's why there's not as many companies going public today as there used to be. It's just not an efficient marketplace right now. So I tend to stay on the private side of things, but certainly as companies get bigger, then IPO becomes more a part of their trajectory.
Now, you mentioned that powerful word, IPO. You talking about initial public offering?
Yes.
And then you also mentioned about PE. You talking about price earnings for that particular business.
No,
correct?
when I'm referring to PE, I'm sorry, I'm talking about private equity. So private equity PE. So PE firms, private equity firms, are segregated into a pyramid based on the size companies they buy, the size funds that they raise, and the multiples for companies go up dramatically as they get bigger. Here's some interesting statistics for you, just to tell you how rare companies really are that are big. So in America today, there are 31 million small businesses. 31 million small businesses make up 99.9% of all companies in America. Federal government defines small business as 500 employees or less. Of those 31 million companies, only 7% have $1 million in revenue. And as you're climbing up the pyramid, there are only 3,000 companies on the planet today that have over $1 billion in revenue. So companies, 31 million small, only 3,000 at $1 billion or higher. As companies get bigger, they get extremely rare. So of the 7% that hit $1 million in revenue, only 4% of those ever hit 10 million in revenue. Only 0.1% actually hit 100 million in revenue. So big companies are rare. They're worth a lot more money. People pay more money to own them. And as they get bigger, eventually there is no more private market. They have to go into a public market. IPO is the process of going public, initial public offering. PE does stand for price to earnings. However, when in my context, PE was referring to private equity.
Now, out of those 31 million businesses, is it a lot of businesses that's for sale that are in the baby boomer stage?
It's a great question. Yes, no question about it. If you think about the baby boomers, I'm officially the last of the baby boomers. I was born in 1964. And so you've got people, I'm 58 right now, but people, that fall in that category, we are very quickly getting to retirement age. 31 million small businesses out there. A large percentage of them are owned by baby boomers. And so as people are getting older, they're thinking about progression. What do I do? Do I give the company to my kids? Do I sell it, monetize it, take my pot of gold and go retire in Florida, somewhere? What do I do to get out of them Philly cold winters? It's like, what's the plan? And so what's happening is, because there's 31 million small businesses, there's so many of them that as people are wishing to exit, there's not enough buyers out there to drive prices up. So prices are relatively low and they're relatively attractive. So if I'm an entrepreneur, call it a younger buck who's looking to get in to a business rather than start something new, it certainly helps. If you think about only 40% of those 31 million businesses are profitable, 30% are break even, 30% lose money. And with those kind of statistics that are out there, hey, maybe it's better to buy a company that's already in existence, that's been already servicing customers, has revenue, has earnings. If I start with something that's successful today, I can take it from there and then continue the journey and grow it bigger. So, starting a company from scratch can be very difficult. And the majority of small businesses that are started fail within the first few years. They're undercapitalized. People just don't have the magic, secret sauce to get that company going. And I try to teach that in the seminars and the books that I write. And so for a lot of entrepreneurs, there is this kind of opportunity right now, called a generational opportunity, with a lot of people aging out that are business owners, might be able to pick up an existing business at a fairly attractive price. And there are certainly all kinds of government programs out there to help people do that. And there's special programs depending on your sex, your race, whether your status, you're a veteran, there's different programs that exist that help entrepreneurs who want to buy a business get that done.
Yes, I know a friend of mine, he actually told me that it's good to buy an existing business that's already generating revenue. And, he sold his company for 4.2 billion. So, that was a huge acquisition.
That's a good number right there. Hats off to him. I'd like to be that person, right? So 4.2 billion is a good number.
Absolutely. Adam, let's have a conversation about what it truly takes to be an entrepreneur. Now, the word entrepreneur means entreprendre, and that was a Latin word that was invented in the 15th century in France. And a gentleman by the name of John Baptist, he invented the word, and over 300 years later, that word still exists, which is entrepreneur. So entre means between, and ponder means to take. So it means to take lower productivity and increase it to higher productivity. Can you explain to the audience, how are you increasing your productivity in your current businesses?
So, one of the things that we don't have necessarily is time. And, when I think about, I'm going to talk about high value work and low value work. When I get into a business and I'm running a company, let's say, for example, I have a service company. It's an HVAC company, and I have this employee who's known as an HVAC service technician. These are highly skilled laborers. It's a trade, and there's a real shortage of tradespeople in the United States. So I don't want that skilled worker wasting time ordering parts, doing paperwork, chasing down menial tasks or doing things. In my perfect world, that HVAC service tech would spend their entire day sitting in front of broken equipment. And so oftentimes when I'm thinking about productivity and increasing productivity in a business, I'm thinking about investments in technology to take low value work, which would be things like filling out paperwork, like ordering parts. And I want to try to automate that stuff or get it away from that high-priced technical labor so that they can focus on doing the high-value work. So let me just paint a picture and give you an example. Imagine you're an HVAC service tech, so you're working on air conditioning systems. You get up in the morning, you roll out of bed, you jump in your truck, and you leave the house. Well, I know you left your house because that vehicle has got satellite tracking. I've got your house geo-fenced because I know that's where you live. And as soon as you got in your truck and left, I also know because I dispatched you your first service call. It's in your little handheld device or your phone. I know where you're going. I know you left. I can clock you into work because you got in your truck and you left the house. I know you're en route. When you arrive in the parking lot of that first customer call, I can check you in on that job. If this is a time and materials customer, I've already gone up to my contracts module. I've scrubbed out whether the customer is paying for your travel time or whether I'm paying for your travel time. And then once you get there, I need to log in your labor, start. You're working, you're solving a problem. You go out to your truck because you need a part. You use your phone and you scan a barcode on a bin because you use that part. I'm looking at that inventory on your truck and I'm saying, you got 5 of those. You use 1 a week. I don't have to restock you yet, but I'm going to put that part you used in a box in my warehouse, and I'm going to start building up replenishment stock for your truck. You go in there, you fix that call, you tell me one thing, I'm done. You go back and get in your truck and you take off. I see that you've left. I know that you're done with the call. I can then figure out what bill is for the customer for your labor on site, for your travel, travel charge or trip charge. I know what part you used. I can restock the parts for your truck. You ain't done nothing. You just got in your truck and you went to work. That's what I'm talking about. Investments in technology to remove the menial, low value work that we all do. It doesn't matter whether you're an HVAC tech, you may be an accounting clerk. And I want that accounting clerk to be doing what I call high value work and not low value work too. So regardless of what your job is within a company in a hierarchy, when I think about being an entrepreneur and building a business, as I'm getting bigger, I'm getting some advantages from scale. I'm servicing more revenue. That affords me the opportunity to make investments. My cost grows at this pace. My profit grows at this pace. My revenue is growing here. My cost is growing here. This delta becomes, call it that added profit that I'm seeking as an entrepreneur building a business. Entrepreneurs, by their very nature, when they're starting a business from scratch, tend to be lone wolves, and they tend to be control freaks. Because in order to build a successful business, I call it perfecting your unit level economics. Imagine that you've got a pickup truck and a lawnmower and you're cutting grass and that's what you do for a living. Then how much does that truck cost? How much does the lawnmower cost? How much is gas for the truck, insurance for the truck? How much can you charge to cut a lawn? How many lawns can you cut in a day? Can we generate enough revenue to cover the cost of the person in the truck that's doing the work, the truck itself, their benefits, all that stuff? And it's like, you want to get a business dialed in small and make sure that you make it profitable small before you start to scale it. If a business doesn't work small, it won't work bigger. If it works small, then you have the opportunity to scale it as large as you want to go, because what you've perfected small continues to have relevance as it's getting bigger. But as you get bigger, you're creating an operating leverage, it's called, because your cost structure starts to go down as a percent of revenue, because you can be more efficient. You can invest in technology and do some of those things that I was talking about. And you're putting more and more trucks out on the road with more and more crews that have lawnmowers cutting more and more lawns. And so the business can grow and scale exponentially. But all business has to succeed small. As a result of that, a lot of entrepreneurs who find success are control freaks, because they're making sure that what is being done with a repetitiveness that's predictable. I call it the Happy Meal effect. If you go to McDonald's and you order a Happy Meal for your kids, you get a red box with yellow handles. You get a cheap hamburger in there that tastes like cardboard. You get orange or apple slices that have been packaged for 100 years. But if I go to any city in the country, Philly, LA, Miami, in Des Moines, Iowa, I go anywhere and I'm going to get the same thing. It's that consistency in a Happy Meal. That's what an entrepreneur is trying to create. They're trying to create a product or a service that's very predictable, that'll have the same outcome every time, no matter who consumes it, no matter where they're at in the country. I get it working small. That gives me a chance to scale it big and to generate the capital I need to make investments to grow.
Yes, I agree with you. Entrepreneurs, they definitely like to, uncover the value in regards to what they can offer entrepreneurs and other business owners. If you uncover a little bit of value, you're going to make a little bit of money. You uncover a lot of value, you're going to make a lot of money. But it's all about, pleasing your customers, because happy customers are loyal customers. They keep coming back to you wanting your products or your services.
Yeah. Arthur, man, that's such a good point. So let me just say something about that real quick. When I come in as a CEO of a big company, I don't even look at revenue. I mean, I'm cognizant of what it is. It's a part of my duty to know what it is. But my focus when I'm growing a company is not revenue. I start at the bottom with culture. If I build a really strong culture, I get an engaged workforce. That engaged workforce takes care of customers. Customers like that. They give us more stuff, and revenue happens naturally. It rains from the sky. So the secret, from my perspective, to building a successful business is not by managing revenue. It's by managing culture at the lowest level, building a strong organization that employees want to get up and come to work at, that takes care of people. It doesn't coddle them. It asks them to work hard, in exchange, but that's the magic in a business. So from my perspective, my goal and objective when I'm a CEO of a company is I want to create an environment where employees can spend their entire career in one place. Hopefully that's my company. And to do that, I have to do 4 things. I have to pay a fair wage, or I'm going to lose talent. And in today's world, it's really, really hard to get talent. Hell, it's hard to get people who want to even come to work in the morning. So I got to pay fair, or I'm going to lose good people. And I don't want to lose good people. Got to have good benefits, because we all get old and fall apart and get sick, and we need health care. Got to have a good retirement plan, because somewhere in life, we all hope to dial back one day and be able to retire. We got to have the money to do that. But I think the most important leg of the 4-legged stool is we really need to create opportunity for people. If people are going to spend their career with you, they have to have advancement potential. They don't have to take it, but they have to know it's there. So a service technician in a truck, that HVAC guy, God bless them if they want to spend 30 years being an HVAC tech, because they become the journeymen who teach the next generation of youth how to do that trade or how to do that job. But I also need the young person who wants to one day be a manager, who wants to one day be a vice president, who wants to one day be a CEO. That's me. I started my career after the service. I was the guy in the truck. So in this country, you can aspire to want to grow. You don't have to grow. So a company that can create opportunities is a company that's growing. A company that's not growing, that's stagnant, isn't creating opportunities for employees, and people will start leaving. So I got to pay a fair wage to attract the talent, keep them there, give them good benefits, good retirement. And then I got to give them an opportunity, a path to advancement if they want it. Being successful and growing a business creates jobs, creates the opportunities that fulfills that obligation. And nowhere in any of that is the magic to running a business focusing on revenue.
You talked about culture, and that's extremely important when you are growing a business to the next level. Culture is absolutely powerful. You ever heard of the entrepreneur? Unfortunately, he passed away. His name is Tony Hsieh, and he was actually the owner of Zappos. And their headquarters is in Las Vegas. But he hired people at the entry level. But if you didn't fit into the culture, he would pay you $2,000, $3,000 to leave, because you was making it bad for everybody else by talking about the company. How do you feel about that business model that Tony Hsieh actually pursued in his business?
Well, God bless him, right? It was an interesting concept. And I think different entrepreneurs have different ideas and different takes on how they want to grow a business. I think so the methodology that they use is different. I don't know enough about that particular company to understand whether or not that's a best practice that I would want to pursue. But I think the concept that he was pointing out is no different than a concept Jack Welch was pioneering way back when he was talking about, A, B, and C players, and the concept of forcibly turning over your bottom 10%, the people who weren't producing, kind of pruning the tree, and then upgrading your talent in order to keep the business moving forward. And, Jack was doing that, in the 1980s, and people have done different variations of that, since that time period. So I think what the underlying concept is, though, is that culture is king. We need an engaged workforce, people who are passionate about what we're doing as a business in order to grow that. And a bad apple can have a toxic impact on the rest of the workforce and can really curtail productivity or curtail the growth of a business. So we want to get rid of bad apples or bad actors or people who aren't believing in what what our core values are. And so I think that concept is pretty generic and uniformly one that most entrepreneurs would embrace. And then the question is just tactical. How do we do that? And he had a unique spin on how to do that. He'd pay people to go away. In some respects, that happens. When layoffs happen, people are paid severance. When sometimes people are terminated, they're paid severance. And so I think the world does it in different ways. The concept is pretty much the same, throughout. We want good people working in our company. Bad apples, bad actors can hurt the productivity and the culture of the rest of the business. And we want to see those people working somewhere else.
Now, Adam, you've been involved in 58 acquisitions, and the revenue has basically grown over 1 billion. Let's just say you are in the market and you want to buy a profitable business. Do you buy that profitable business for scalability and high growth mode for EBITDA, or would you buy that book of business to basically build the book of business up in that current business?
So good questions. You're talking about really what's the strategy around M&A and mergers and acquisitions, and what is a strategy that I'm seeking. If I'm assuming I'm the CEO of an existing company already, there's usually 3 strategies that I'm trying to employ. Maybe I'm the CEO of a smaller regional company, but my goal and objective is to build a national company and then an international company. And so, when I'm in a regional business, my 3 strategies normally are: I'm wanting to extend my geographical reach. So I want to go from being a West Coast company to being a West Coast and an East Coast company, and I'm filling in kind of the map. Think of it like, you're coloring states on a map, and you're in one part of the country and you're going to other places. Very efficient way to do that is by buying other companies that are in the same industry that you are, to kind of catapult or launch you into a new market. And so that's one reason, is to extend my geographic reach. Another reason I do it is because I want to add a new strategic capability. So my company does this. I want to do this plus something that's just off to the side of it. Oftentimes I'm doing that to increase my addressable market. So example, I'm running a refrigeration service company. It works in grocery stores. That's about a $4 billion addressable market. It's commoditized somewhat in that there's always bids to win the service contracts. And when you're competing, your margins are pretty thin. And so I make strategic pivots. I buy an HVAC company that works in small box retail. Someone like Starbucks is my typical customer in that environment. And that's a $20 billion addressable market. So I've gone from a $4 billion addressable market that's really heavy competition, and I'm now expanding to a $20 billion market. Now I'm doing HVAC at pharmacies, at pharmaceutical storage facilities. I'm doing data centers. I'm doing all kinds of places where potentially the competition is not as fierce as it was in the original business. So that's a reason to add so I'm adding geography, I'm adding capability, I'm increasing the size market that I can play in. And then finally, usually the third reason I do M&A is because I want to build density in a market. So go back to that guy in the truck who's doing a service call. Driving around is evil because he's a high-level skill set person, and driving his truck from location to location is not productive time. If I have more customer locations in a small geography, they'll spend less time driving, more time working in front of broken equipment, using that high value skill that they've got. So density in a service business is a huge factor to profitability. So I may be buying other companies to fill in my density. I once ran a company, and we were in Southern California, and I was building density in Southern California. There's a city called Long Beach. I had 8,000 customer locations in the city of Long Beach. Literally, my service technicians could take their trucks and drive them and park them in the middle of a neighborhood. And they had enough customer locations to work that they could walk the entire day, put their truck somewhere in the middle, walk to a location, come back, get the parts they need, and just walk from location to location, because we had so many locations that they didn't even need to get in the car. It was harder to go drive and find a place to park than it was to just walk to your next service call. And so building density is important to profitability when you have a services type business. So I'm looking for a strategy around why it is I want to buy something. If I don't own a business and your listeners don't own a business and they're thinking about maybe buying one of these retiring baby boomer companies, I like to apply what I call as the phone book test. So for people old enough to remember a phone book, it used to have yellow pages in the back and white pages up front, and the yellow pages in back were business. If I went to any category of business, dry cleaners, or pizza, pizzerias, restaurants, whatever, go to any category. If I could open up 40 phone books in 40 different cities and find different names, I'm always going to find I'm going to find Little Caesars and Domino's and Papa John's, right? In every phone book, if I'm looking at pizza. But if I find a lot of local names in each one of these cities, and those are different, then I guarantee you there's probably 20,000 or more of these companies in the United States. It passes the phone book test. It means that there's high fragmentation. So the company I buy is going to be low priced because there's so many of them and they're owned by so many different people and they're all retiring at the same time. So only so many buyers for them. And that fragmentation becomes my friend. As I'm growing my business, I may start buying other small businesses that are just like me, and I'm adding them together. And again, as I'm getting bigger, I'm climbing up this pyramid of rarity because bigger companies are so rare. As I'm getting bigger, I'm becoming rarer and rarer, and the value of the company I'm building is going up dramatically. And as a result of that, I'm making money by buying small companies cheap, putting them together and creating a bigger asset. And when I sell that bigger asset, I make money off of all that activity. And it's an easy way to make money.
You mentioned that powerful word scalability. And earlier you talked about the golden arches, which is McDonald's. And I know Ray Kroc, he's seen a golden opportunity when he actually purchased McDonald's, but it wasn't for the McDonald brothers that was willing to sell that franchise. He never would have had the opportunity to excel that franchise to the next level.
And you know what, that's a good point, because I'll go back to something we talked about earlier. In that particular case, the brothers that started McDonald's, they were, call it that entrepreneur that sold their business, call it to private equity. And what happened was you then had the marriage of a great business idea and concept with someone who was thinking bigger than the brothers were and thinking about the scalability and how do we make this great little, hamburger stand? How do we turn it into a national franchise? And so you couldn't have done this without both of them. Right. So you had to have the idea, the concept that the brothers put together to create the restaurant. But then, Ray, you had to have the vision to say, how do I take this now and blow it up and make it a national phenomenon? And so it took them both to create that. And although there may have been animosity between them, along the way, the end result is the combination of that higher level thinking, that kind of turned McDonald's into a corporation, that also augmented with the great idea to start the restaurant that was kind of the first fast service restaurant on the planet. It was the marriage of those skill sets that created the McDonald's that we know today. And without either one of those parties, McDonald's doesn't happen. But the end result of that talent coming together, is what created it. And that's what's similar when I'm talking about private equity as a potential partner to an entrepreneur who's growing a business. They're the McDonald's brothers building the first restaurant. Private equity comes in with the capital and the knowledge and the wherewithal to help them scale it to a larger place. And it's the marriage of those uniquely different skill sets that, when it's done properly, creates what I'll call a magical or a differentiated outcome.
Adam, let's have a dialogue about money. Now, I know money is not value. Money is just a facilitator to do transactions. Can you explain to the audience, how would you define money?
So money is a tool, is the way that I look at money. Money is a tool. So in life, we might keep score by how much money we have and what kind of house we have and what kind of car we drive and life we live. So money is a tool that we use to buy things that help us keep score. Money is a tool, the whole phenomenon around, call it Bitcoin and cryptocurrencies and all these, throughout history, gold was a currency once upon a time, silver was a currency. Goods have been currencies. Money today is just the fuel that lets us exchange goods. And it's a tool. It's a simple tool. I need money in today's world to buy things. It is the currency by which all business is transacted. Crypto is just another way of saying, I'm going to put, instead of money, I'm going to put cryptocurrency in the middle. But in olden days, it may have been gold, it may have been silver. There was always something that was demonstrated to be of value to a broader community. And they would say that thing, whatever it is, money, paper, gold, silver, or even goods, that's a currency in and of itself. We all value it. And so in order to get it, we're going to exchange goods and services in order to collect it. So I see money as nothing more than a tool. It's a tool. I, as an entrepreneur, when I'm working with a private equity firm, I'm a tool. They're putting money to work, they're buying companies, but their output is more money back to their shareholders. And the tools that they're using are me and the company, the physical asset that they buy using money. I get in and grow it. They give me some of that money in exchange for doing a good job for them. And then they return the money to their investors. But the vehicles that they use require some currency in order to obtain them and build them. And so, for the modern era, going back thousands of years, we've had some type of monetary currency, but really it's just a tool. It's a tool by which we can exchange goods and services. And, I recently was working with a group of entrepreneurs and they wanted to buy each other, but nobody has any money because they wanted to become a big enough company that they could sell to a private equity firm. And so I introduced the concept of a cashless merger. Let's take all these small companies, let's build a bigger company by contributing all of our businesses into a new entity. And then if you think of the whole as being 100%, whatever you contributed, you were 12%, you were 22, you were 35. That's the stock in this new entity that you get. No money changes hands. It's a cashless transaction. And then we turn around and sell that asset to private equity. And then we get, paid for it. And then we distribute that to all of ourselves based upon our percent ownership of the business. So I look at, money is also an obstacle for a lot of people. Hey, I want to buy a business. I don't have any money. How the hell do I buy that business? Well, there's a lot of different things that I could do. I could ask the owner of the business to hold back a loan, hold back a note. Maybe I'm paying $1 million for that business. Maybe I can raise $200,000 by going to the Small Business Administration and getting a loan. Maybe I can, family members chip in some money. We pool up some cash. We got a down payment. I ask the seller to finance the rest, or to give me a loan to go with a bank loan. It's like money is a tool. And in the absence of having that tool available, I'm looking for alternate tools. I can cut a board with a saw. I could probably use a bunch of other tools that might look ugly, but a hammer and a chisel, I could probably cut a board too. It just take me a little longer. It's like, if I don't have money as a tool, then I'm looking for how do I get it to, taking money out, how else can I facilitate this transaction? How can I buy a company without any money? And there are a number of ways to do it. I just described one. A cashless merger of multiple small companies equals one bigger company that we sell, and then everybody takes their portion of the profits. And getting seller financing, getting loans from banks, getting loans from Small Business Administration, from friends and family. Those are ways that I can raise capital if I don't have it to buy a small business.
You said money is a tool. So would you say that money is the byproduct of the value that you uncover?
Yeah, that's an interesting question. I think the way we keep score in the value that we're creating is what we're building is worth more money. So money can be a scoring system as well, because an asset that I paid this for and got this much in return, that was a bigger amount, that demonstrates the value that I created. So it's how the world keeps score. The modern world keeps score in using dollars.
How do you feel about asset-based lenders?
So I think that there is a place in any business, in anyone's life, for leverage, or for having some debt. So let me give you an example. Let's assume, Arthur, we're buying a house. If I put 50% down on a house and I borrow 50% from the bank, or I think of what house could I pay 100% cash for with no mortgage? I'm going to get a smaller house. I may not like it as much. And so I decide, 50% down, I'm going to have a mortgage. I would feel pretty good about having 50% equity in my house. I don't have to buy that big a house. I could get a smaller house and pay 100% cash, but I want the bigger crib. I want it to look good. I want to feel good about it. I want it to be in that better neighborhood, and it's a bigger house, and I'm proud of that house. And so I'm going to borrow some money from the bank. When you think about our history, I think about my parents. My dad passed away not too long ago. My mom's 91. She's still with us. They both grew up during the Great Depression. And then they grew up during World War II. And then they grew up during the Korean War. It's like in a very short period of time, they went through a lot of different trials and tribulations. And what is common amongst people of that age group is that they're averse to debt. They grew up in depression when nobody had anything. And so leverage to them was evil, because if you owed money to somebody and you didn't have money to pay the bill, you could lose the asset. So that entire generation was very conservative with how they think about money. And there's nothing wrong with that. But in my world, when I think of business and finance, I think that some debt leverage is good. So why would it be good? Well, if I'm an entrepreneur and I own 100% of my company and I have no debt, what happens if I own a restaurant and then a pandemic shutdown happens, like happened in March of 2020? All of a sudden, my restaurant has zero revenue. I'm closed, and okay, so let's use a movie theater as an example. What happened to movie theaters during a pandemic? It's like your asset known as your company can be destroyed at any moment by action of a government, by action beyond your control. Imagine all the people in the Ukraine who had livelihoods and businesses and careers, and a war happened, and it's being fought in their midst. Americans haven't had to deal with that, since the Civil War here, but if you think about the fact that something in life could happen to destroy the value of your business and you have no control over it. We didn't have control as business owners when the government shut down all of our businesses and everybody went home and put masks on, and wars happen and things happen that are beyond our control. And if I've got 100% equity in my business and my business gets shut down, all of a sudden it's worthless, I have just lost 100% of my net worth. So there's this thing in investing called asset diversification. It's not good to own 100% of everything, if it's one thing, because it can be damaged. If you had just one stock in your portfolio, a portfolio manager would say there's too much risk. Something bad could happen to that company. And as a result, you should own many stocks in your basket and have a diversified portfolio. So some companies do well, some do bad, but you're balanced and your money doesn't go to zero. Same thing with your company. If you use leverage and debt, and you allow some leverage, then you can take cash out of your business, put it in some other kind of an asset, and you can protect yourself and your family from having a high risk thing like a private company with all your money tied up in it. And same concepts, asset diversification is important. So when you talk about lending, any kind of lending, I think some leverage on business is good, because it allows me to diversify my assets and to make sure that I'm protecting my family's future in case something goes bad.
Adam, I appreciate you coming on my show today, because the whole premise of my show is to educate entrepreneurs and business owners that they can live the life that they truly desire, but they have to be open to these important principles. So I don't like what I see with some of the news, so I create my own news.
Well, that's a good way to be. Focus on things that are important to your life. And I would tell you, if you look at American history, the majority of wealth in this country is created by small business owners who take a risk. They take a stab at being an entrepreneur, and those who find success is how most wealth is generated in this country. It has been historically. Some great books out there to read. An early book, it's old now, but The Millionaire Next Door is one I'd recommend to the people who listen to this. It's an old book today, but if you want to be successful in life, you can read about a book. In this book, a group of guys interviewed 1,000 millionaires, whatever that number was, and they built the profile of what success really looks like, because it's not as flashy as you think it is. And it's like, you can be successful in this country, and it doesn't matter who you are, where you come from. You can be an immigrant, you can be a minority, this country creates opportunity. And if you take risk and pursue opportunity, then you can go from very small means to extremely wealthy in one generation, or two. You can go from immigrant to president of the United States, in one generation. From you to your children can become the president of the US. It's like, this is still the land of opportunity. We have our issues and we have our problems, always have. We've never been a perfect nation, but entrepreneurs and their efforts and small business is the backbone of this country, still is to this day. And if you're truly interested in generating wealth and security for your family, this is a path that it doesn't feel like it's as taken as often as it used to be. We encourage people to go to college and then go off and work for big companies, but small business is the key to wealth in America.
Entrepreneurs is the wave of the future. And you mentioned about technology, and technology is constantly evolving, and the millennials are actually pursuing technology and creating businesses out of getting involved in the technology space.
I would also just say that, there's this old guy out there called Warren Buffett, and, I'm mindful of advice Warren, once gave, and I quote it backwards from the way he quoted it. The way I like to say it is, invest in what you know. Too many people out there, I think, are trying to recreate a wheel or come up with the newest, latest, and greatest, when, the simple things that we know and understand in life represent our best opportunities for success. When I think about business, once upon a time, I ran an experiment. I heard Warren Buffett say those words, and it's, and essentially invest in what you know and what you believe. And I thought about my own life, and I thought, what do I know about my life? I know that Amazon comes to my house every day and drops off packages, because that's just how we order stuff. And they come to every other house out here too, not just mine. And so that's what I knew. I knew that Amazon was disrupting the way people shop. So I knew that. I knew that all my devices were Apple, and I knew that I liked Apple products. And I knew that about 90% of the educated world seems to have Apple devices too. And so what did I know? I knew that Apple was going to be a very successful company. I knew I went to Home Depot all the time, because I'm forever working on projects, around the house. I didn't go to Lowe's. I go to Home Depot, and so that's something that I knew. I knew that everybody had a Gmail account. I knew everybody was spending time on YouTube. I had a YouTube channel, and so it's like Google was in that mix too. And it's like, so I invested a sum of money in the companies that I knew were having a big impact on my life, assuming that they were having an impact on your life too. What happened 5 years later? A $500,000 investment became 2.5 million. That's what happened. I invested in what I knew. When you're looking at business and you're thinking about business, invest in what you know. What do you know? I know that people got to eat. I know people got to spend have to have a place to live, and there's a difference between needs and wants. You know,
Right.
I need something is far better than I want something if
Mhm.
you're an entrepreneur investing. And the reason for that is anytime I want something, if the economy goes south, if I get laid off, I
Mhm.
can I can turn it off. It's discretionary. I can turn it off. I want my wants change based upon whether I'm doing good financially or I'm not doing good financially. But something I need, I always need. I may buy less of it, or I may buy it not as frequent, but if I need it, I gotta have it. You know, I need toilet paper, I need toothpaste, you know, I need food, I need a place to live. It's
Mhm.
like I need stuff, I want stuff. If you can create a business that takes care of what people need, then you have a better chance of being successful than if you take care of somebody that provides things that people want. Because
Mhm.
wants are cyclical, and recessions, our wants change, our needs never go away. So I kind of think about it in terms of I invest in what I know. My companies tend to be simpler: guys, trucks, broken stuff, you know, guys, trucks, building things. Not to sound sexist, ladies, but it's kind of a services mentality, whether it's home services, commercial services, you know, it's people building and doing things, providing, you know, services. And so I try to focus on needs, not wants. And I never wander, you know, into something that I don't understand or I don't know, because when I understand, you know, my world, I'm far better equipped to be a successful investor. So I'd say that people investing in what they know rather than chasing a shiny penny will probably be more successful. And you can be successful in companies that are not very sexy
Mhm.
and not very, you know, attractive to the common person.
You mentioned billionaire Warren Buffett, and I know Warren Buffett and his business partner Charlie Munger, they are value investors. Would you consider yourself, Adam, a value investor?
I consider myself a value creation investor.
Mm.
And so a little bit different. So there's something to be said though about that, because they're not just value investors, meaning they don't look for something that's cheap
Mhm.
and bad. They look for something that's good but undervalued. And and so I'm always looking for good companies. You know, buying a fixer upper is just not where I want to play. It
Mhm.
can take way too much of your energy. I want to grow something. I want to build something special. I'd rather collect good companies and pay a little bit more for good companies than collect a bunch of cheap bad companies and try to make something out of it. So I would tell you, entrepreneurs, if you're out there looking at businesses, don't buy fixer uppers, buy good businesses, buy
Mm.
good businesses that take care of customers' needs, you know, and then focus on getting it at a value price. Maybe it's in a recession, their income is down or their revenue is down. That's a great value time to come in and buy it, but only buy good companies. So don't confuse value with good and bad. It's
Mm.
I want to buy nothing but good. And that's why if you look at the companies that Warren, you know, invests in, these are good companies. They may be undervalued to the market because we're in a downturn. That's the time to bet the farm, is when everybody else is selling something. That's when I want to be a buyer. And I want to be a buyer of something that's good. And when that market comes back, those assets will recover quicker than other assets, and they will grow higher, faster, and go farther than an underperforming company or a bad company that was available at a good price. So that's my take on that.
Adam, can you explain to the audience in your own influential way, what is the best advice that you have ever received?
So I go back to my days at GE. I was in my job, Fortune 500 company, world's most admired company. I had a chance to leave to go be president of a smaller company for the first time. And I struggle with that decision. Is it better to stay in the security and safety of this giant Fortune 500 company where I'm doing well, I'm an up and comer, you know, or am I better to take a risk of leaving? And my mentor at GE said, Adam, once a president, always a president.
Mm.
And that was the best advice I ever got. And what he really was saying was, don't be afraid to take a risk when the risk is going to potentially be life-changing for you. He told me that at GE, I would never be seen as a president because of the way I came up through the ranks. And he's right. But if I went and became a president somewhere else, then everybody for the rest of my career would see me as a president and see me as qualified for roles for consideration as, a president or a CEO. So best advice I ever got, but it wasn't just about being a president. It was really about risk and taking a chance. There's so many people in life, live their life in a cubicle, or an office, or at their job, and they think about the road not taken. 20 years go by, I wish I would have, wish I could have, but I never did. And so I would tell you that life is short. We're blessed to be here. There's no guarantee for tomorrow. So I intend to play every card, that I'm dealt, and to be thoughtful about taking risk and making sure that I leave no road untraveled if I think there's potential there. So I learned early that it's okay to take a calculated risk. I want to do my best to minimize making a bad decision, but don't be afraid to take a risk. Don't be afraid to try. It's okay to fail. We learn when we succeed. We learn when we fail. Life is a learning experience, and it's those experiences that collectively make us better. I look at my life. I have been a soldier. I've been a pilot. I've been an engineer, a CEO of 3 companies, a best-selling author. I just created my consulting business. It's a multi-million-dollar business. I've had a good run. I tell people, boy, whenever my day comes, don't cry for me. I'm an Irish boy. Prop me up in the corner and break open the liquor and start drinking, because I had a good run. And when the good Lord wants me, he knows where to find me. So I believe in taking some calculated risks, enjoying life, and don't be afraid. So I think that's my best advice for your listeners.
And I wrote down some powerful words, 10 being the highest and 1 being the lowest. So you can rate them in your own powerful way. Are you ready?
Okay, go ahead.
Perseverance.
Oh, perseverance is a huge value. So I'll call that 10 billion. Is that it? 1 billion, 10 billion?
10 the highest, 1 the lowest.
I'm sorry, 10. Say that again. 10's the highest?
10 the highest, 1 the lowest.
Okay, perseverance, 10.
Family.
10.
Leverage.
5 or 6.
Wealth.
5 or 6. Wealth is an outcome. It's an outcome.
Health.
That's a 10.
Speed of implementation.
I'll give that a 7, 8.
Financial literacy.
Oh, that's definitely a 10.
Gratitude.
10.
Attitude.
That's high up there too. Call that a 10.
Money.
Yeah, that's a 5. It's a tool.
Marriage.
Yeah, 10.
Key performance indicators.
Yeah, 6. Keeping score is important, but it's not the only thing that's important. You need the score system, but it's not in and of itself. To me, it's not a 10.
Private equity.
Yeah, that's a tool. So 5.
Donald Trump.
Yeah, you know what, boy, that's a political, statement and a half there. I'm running from that question. So here's what I think. Life is too polarizing. So I'm going to put that at a 1, because I don't care whether you're Republican, you're Democrat. We are too polarized as a nation. We are too much in our camps. We need to find a way to come together. I don't care whether you are Republican or Democrat. It's like, I'm going to put any politician as a 1. I don't care what party they're from, because they're all tearing us apart.
Market growth.
Yeah, 5.
Top line revenue.
Yeah, that's a 4 or 5.
Hiring the right people.
That's a 10.
Building great relationships.
That's a 10. You know what I'm learning about all these words, Arthur? When you talk about character, that's a 10. You talk about family and faith and what we believe as human beings, that's a 10. Anything else you're talking about, that's noise. That's a tool. Private equity is a tool. I've earned a living working with private equity, but they're not important. You know, it's a tool. I'm a tool to them. They're a tool to me. It's like when you talk about, you know, politicians, put them at a one, both parties. They can sit down there all they want. It's like, I think that your character in life matters. What you believe and how you treat other human beings matters. The rest is noise.
Courage.
10.
Action.
Yeah, I'm going to put 7, 8, 9, you know.
All right.
Important.
That was good. That was real good, Adam. Can you explain to the audience exactly where they can find you?
Yeah, so I'm on LinkedIn. You know, LinkedIn is a great place to find me. Just spell my name right. It's Adam Coffey, Coffey. You know, you can find me at adamecoffee.com. Find me on LinkedIn. Go on to Amazon. You can find my books. Just you know, Adam Coffey. Hell, I even have a Wikipedia page. So I guess somebody out there liked me. So you know, I love talking to people. I engage with people all the time, and I love hearing from people. So that's where you find me.
I know earlier in the interview you talked about Amazon, and Jeff Bezos is actually, you know, blowing everything out of the water because, you know, Amazon, they are the largest online retailer in the world.
Amazon could control the world if they wanted to. I think they could disrupt any industry at this point.
What inspired you to write your phenomenal book, The Equity Playbook?
It was really you know, I was walking the dogs with my wife one day, and she was like, you know, she kept pestering me. You need to write that book. You need to write that book. It was really my way of giving back. You know, I've been blessed. I've been successful in life. And I found that most people have a negative connotation towards private equity. They really don't understand it. Even to this day, you know, you put me in a room with 300 people. First thing I do is I give them a quiz, 10 simple questions. And there are multiple choice answers. They're all found in that book. And, you know, 90+% of the room will fail that test miserably. It's a word we've heard. It's a word we might think we understand, but we fail the test miserably. We really don't understand it. And from my perspective, with it having 5 trillion in assets under management, there's 1.9 trillion in cash committed looking to buy companies right now. And the fact that they buy more than 50% of all companies sold on the planet, we as entrepreneurs and business people need to wake up and understand how this animal works so that we can navigate it and I hate to say it, but manipulate it to our advantage as entrepreneurs, as business owners. We have to learn what this thing is and all about that has very quietly become, you know, one of the largest economic forces in the world today in order to be successful. So I wrote that book so that others could get a simple primer into the world of private equity, what it is, how it works, how it makes money, and how you can take advantage of its needs in order to partner with it and get a good outcome.
Adam, let's have a dialogue about delegation. Now, I know the minimum wage of a millionaire is around $524 an hour. So I always tell my audience, what can you delegate for $524 an hour? Or you can go way beyond that. What can you delegate that's within your current budget? How important it is for entrepreneurs and business owners to delegate tasks out that they're not currently good at, so they could just focus on increasing their revenues in their businesses?
It's really important. I'll go back to what I was calling high value work, low value work. High value work for me is working with my clients and helping them find success. Low value for work is exchanging emails all day long saying, well, here's when I'm available this date, this time. You know, so I embraced, you know, the technology of Calendly, as many people do. And so I now have, you know, call it a virtual technology tool to handle all my scheduling. It automatically gives you the appointment, sends out a Zoom link, and that low value work is taken off my plate so I can spend more time on high value work. I think it's important for all entrepreneurs to think about it in terms of what is your time really worth? And where do you spend most of your time doing? And how can you find the low value work in your life and offload it to either technology or somebody else so that you can focus on doing things that add value?
Adam, what do you like to do for fun?
I'm a pilot. There's a picture of me up there in a World War II P-51 Mustang flying upside down in Orange County, California. So enjoy that. Enjoy traveling. Love history. Love going to Europe and seeing old things. I'm a lover of history. Like to read. I don't really read anymore. I go for walks every day and I listen to books on tape. And if I want to know what's going on in my book, I got to get out there and start walking. So I've taught myself how to connect exercise with something that I always enjoyed doing, which was reading. So travel, I enjoy spending time with my family. And that's pretty much it. I love eating too. Man, I love going out for a good. So I got to be really disciplined, keep the weight off of here. I lost 30 pounds in the last 6 months. And, part of that is exercising regularly and trying to eat smart, but love to eat, love to travel, love spending time with my family, and I enjoy business.
I enjoy eating as well, and I love reading. And for some people, reading is a lost art today. How do you feel about entrepreneurs and business owners formulating brainstorming groups? And should entrepreneurs create more brainstorming groups to help everyone in that group to excel to the next level?
Yeah, so there's all kinds of peer groups out there in existence today. There's YPO, there's Vistage, they're a dime a dozen. Here's what I would tell you. I think it's always great to leverage the learnings from other people, but you never want to be the smartest person in the room. If you're the smartest person in the room, you're in the wrong room. And so you have to be really mindful about these peer groups, because if you got 10 people who don't know the answer and they're all guessing, then you get 10 wrong answers. So I would tell you that if I'm going to think about a peer group, I'm going to want to make sure that they are people that can bring to me diverse opinions that are not telling me what I want to hear, but giving me their thought and challenging my own thinking so that I can grow. And if I'm doing all the talking and I'm not doing any listening, I'm in the wrong peer group.
Adam, do you have any last pearls of wisdom for the audience?
Be good to each other. Don't forget that life is short, and 100 years from now, nobody's going to care how much money you had in the bank account. So I think it is incumbent on all of us to kind of think about life and our families and our friends and the people that we come in contact with. And there's a whole bunch of division in this country right now. And I really wish there was a better place where we all got along a whole lot better. And I think it starts with each one of us, deciding to treat people better and to listen to opposing opinions and to stop being so judgmental. And I think that the news has become just toxic entertainment for our own camps. And I miss the days when we all used to turn on CNN, and say, what's going on in the world today, and people told us news. Today we get polarization from both sides, and as a result we get told not the truth but some variant of the truth, and so we're all searching for truth. So I think my final word of wisdom: be good to people, be good to each other, treat people how you want to be treated, and don't forget that family's more important than work. But at the end of the day, there has to be some kind of balance, because we got to earn our way through life, because we need that tool called money. That's it, Arthur. Time to go.
Adam, I appreciate this conversation. You are a gift from God.
I don't know about that. I'm just trying to do my best to give back. So I appreciate the chance to be here, and I'm thankful to all your listeners out there.
To everyone that's listening and watching right now, I highly recommend getting involved with the phenomenal Adam Coffey. You hear the passion that came through his voice on my show today. He broke down layman's terms about treat people the way you like to be treated. He broke down layman's terms about the power of business acquisitions. And he also talked about his phenomenal book, The Equity Playbook, and about the power of private equity. I highly recommend go to his website, adamcoffey.com. He has incredible content that could take your mindset and your business to a whole nother level. But remember, you have to implement what you learn. Knowledge is not power. The implementation of knowledge, that's what makes it become powerful. So to everyone that's listening and watching right now, remember that the strongest asset that each and every one of you have is your brain, and what you think about and what you take action on, that will become your reality, and your mentality creates your reality. May God bless each and every one of you, and bye for now. Thank you, Adam. I really appreciate you conveying value to my audience.
Take care. Nice to see you.
The pleasure is all mine. It was great seeing you as well. And bye for now.
Take care. All right, man. Thank you much. I got to run. I got another one coming up in 5 minutes here.